right? So the modern economies, the way modern economies work, and today we'll see in our class that money supply comprises of currency notes, which we cash, that we carry in our pockets, in our wallets, and go and buy goods and services. Plus, it's also the bank loans that banks issue, right? Now, the idea is, first things first, so money supply would be sum of currency notes plus bank loans, right? Okay. Now, moving on, we briefly talked about how banks operate, right? So banks are an intermediary that connects savers with borrowers, right? So some people in an economy are savers who save money, right? Because their income is greater than their expenditures, so they save some money. Why would they put their money in a bank? Because they get some interest out of that, right? And then there are other people on the other hand who are borrowers, right? Now this is something that we have already talked about. Then we started in the last class we also talked about that how interest rates are determined, right? Because the way banks operate, they charge interest to borrowers, and then some of that interest goes to savers, right, as an incentive to save in a bank, right? Now have a look at this, right? So let's say savers are paying 10% interest to the bank, right? On whatever amount they borrow, they get paid 10% interest to the bank, and out of this interest, some of it will be paid back to the savers, because otherwise if bank doesn't have savers, there are no people who deposit money in the bank, then where will bank get the money to give it to the borrowers? Are you getting me? So bank is basically just connecting people, right? So the remaining 2% profit, right, is bank's profit. So that's how banks make profit on their operations, right? Then the big question that we wanted to answer, how interest rates are determined, right? This is something that we've already covered in the last class, so we are doing a quick recap. But in case there is any confusion, you can just go back and look at the video, or if there is still any trouble, I can explain you later, right? So how interest rates are determined. Now, interest rates are basically the cost of borrowing, right? So interest rates are the cost of borrowing. Why? Because when you go to a bank, no bank will lend you money without interest, right? So the idea is, that's why we say that whenever you borrow, you have to pay interest. So interest is cost of borrowing, right? Now, there are two theories I told you that we'll talk about. The first one we have already covered, right? And that was loanable fund theory. So the first theory that we talked about, and I'll give you a quick overview of that, loanable fund theory, right? And the second one, which we could not complete, and we'll complete that in today's class, is liquidity preference theory, right? So loanable fund theory, just a second, let me quickly write these two words, loanable fund theory and liquidity preference theory, right? Liquidity preference theory. Okay. Now, for the loanable fund theory, the idea is quite simple, that just like any other product in the market, right? So if you think about how prices for laptops are determined, or how prices for clothes are determined, or how prices for cars are determined, right? So in economics, everything boils down to market forces, right? So market forces of demand and supply, right? How much is the demand for a product? How much is the supply of that good, right? So where demand and supply are equal, that will be equilibrium price, right? Now, similarly, loanable fund theory says that interest rates will be determined where the supply and demand for loans is same, right? So on the y-axis, if you can see, I have interest rates, and on the x-axis, I have quantity of loans. So how much loans are issued in the market, that is on the x-axis, and how much interest will be charged on each loan that's issued, that's on the y-axis, right? Now, what you have to do, you will see that there's a down sloping demand for loans, and there's an upward sloping supply for loans, right? So you can write this as SL, supply of loans, and DL, demand for loans. Now, we also talked about that who demands loan and who supply loans, right? So demand for loans is made by borrowers. Now, borrowers include individuals, like people like us, Let's say I want to buy a car, but I don't have enough amount. What will I do? I'll go and take a car loan or car financing from a bank, right? So I'm an individual who wants to borrow money. And then companies also borrow. Firms, corporations, they also borrow. Why? Because they're investing in a new project. They want to expand their operations and things like that, right? So borrowers are basically individuals and companies. Okay. Now, who supplies loan? Obviously, the banks, right? So the money that banks have available through depositors. So that money is what banks make available for people to borrow from, right? Easy. Okay. Now, where the supply and demand for loans is equal, that is the equilibrium point, and that shows you how much will be the equilibrium interest rates and how much will be the quantity of loans issued. So let's say in a certain economy, 10 million worth of loans are being issued. So that's the quantity of loans issued. And on average, the interest rate paid on each loan amount is 5%, right? Whatever amount you borrow, you have to pay 5% on top of that to the bank, right? In interest, right? So this was loanable fund theory. This is loanable fund theory, which says that interest rates are based on the market forces of demand and supply. Any confusion so far? The second theory that we will complete off today, right, is liquidity preference theory. Now, liquidity preference theory looks at, this idea of interest rates from a slightly different perspective. What is that? Let me explain you. So liquidity preference theory says that it's not the demand and supply of loans. Instead, it is the demand and supply. It's the demand and supply of money, like the currency notes, that determined interest rates, right? So liquidity preference theory says that it's the demand supply of money that determines interest rates. Okay. Now, when we talk about the demand, let me choose a different color. So when we talk about demand for money, so we asked ourselves that why people want to hold money, right? So what's the reason people want to hold cash or people want to hold money? So that's one side, and the other side is supply of money, right? Like who supplies money or cash in the economy, right? So supply of money, right? So first thing, demand for money. So there are three reasons why people want to hold money, right? So the first one being transactionary motive, right? So people want to hold money because they have to make transactions, right? Transactionary motive. Then the second one is precautionary motive, right? In case you need some extra cash, right? Transactionary motive, precautionary motive, and the third is speculative motive, right? Transactionary, precautionary, and speculative motive, right? So these are the three reasons why people want to hold cash. Now, if you remember in the last class, we also talked about, I'll explain you again what each of these three motives basically mean, and then we will look at the graphs, right? Now, the first one is very simple and obvious, that you need money to make transactions, right? So I go to shop to buy something, food, clothes, whatever, right? Whatever I need, right? I will always need cash to exchange, to buy goods and services, right? So that's transactionary motive. The second is precautionary motive. So sometimes we hold extra cash. You must have seen your parents, you might have done the same for yourself, that whenever you're going out, you always keep some money in your pocket, no matter, no one knows, you might need it, right? Let's say you might need to book a ride, you might need to, buy something, you like it or something, right? So this is some extra cash that you want to hold for unforeseen circumstances, right? And then this is important. Now, this is something that would be confusing, but the way I explain you, and I'm repeating that, think about this. If the interest rates in a bank, right? So what do you do with your savings, right? So what do you do with your savings? So one is your income, right? So from your income, you do spending, right? Which is consumption, right? You spend money on buying goods and services that you need, right? So spending or consumption. The remaining portion is your savings. Now for your savings, what you're trying to do, so this is one part of it, right? And this is the other part. Now for your savings, what you're trying to do, you are trying to get a good return on savings, right? Yes or no? So you will put your money where you get a better return. So investing money in a bank is one option, putting in gold, buying stocks, putting in cryptocurrency, right? These are all different saving channels, right? Now, if interest rate and the banks are low, then people don't put their money in a bank, right? Which is kind of obvious to understand. Instead, what they do, they hold cash till they find some good investment option, right? They hold cash till they find some good investment option. Are you getting me, right? So think about this. Now comes in the main part, and I want you all to pay close attention, right? So the transactionary motive will be regardless of interest rates. Now we are about to look at the graphs, right? So transactionary motive, right, would look like this, right? It will be a straight vertical line. So you have quantity of money on the x-axis, you have interest rates on the y-axis, right? So you have interest rates on the y-axis. So regardless of how much are the interest rates in an economy, regardless of how much are the interest rates in the economy, right? You would hold a certain amount of, money for your transactions, right? So why? Because think about it. If someone needs $500 per month for their, basic expenditure, like buying foods or buying food or spending on rent and, paying basic expenses, right? So whether interest rates are high or low, you need this money to make your transactions, right? So you will not be like, oh, the interest rates are going up in a bank, I should not buy food this month and instead put my money in a bank, right? You can't do that. You can't afford to do that, right? So regardless of the interest rates, you will want to hold this money because you have to make some basic expenses, basic expenditure, right? So this is known as, this transactionary motive is perfectly inelastic to interest rate changes, right? Transactionary, so I'm just writing this as TM, transactionary motive is interest inelastic, which means that no matter what the interest rates in the market is, interest rate inelastic, right? You will want to hold a certain amount in form of cash because you need that, right? That's what it is, right? Okay. Now, this similarly, just like transactionary motive is inelastic of interest rate changes, your precautionary motive is also inelastic to interest rate changes. Again, the same reasoning. And the reasoning is that if you need to hold $200 or $300 extra every month, you want to hold it because as per your experience that oftentimes you spend more because of unseen for circumstances which I explained you, then you will hold this amount in your wallets, in your pockets, regardless of what the interest rates are being offered by the bank, right? So whether interest rates rise or interest rates stay low, you will always hold $300 in case you need to spend it somewhere, and so on and so forth. Easy. Any confusion so far, right? We good on this? Can you move on, right? Okay. Now this is a precautionary motive, which is also inelastic to interest rate changes, right? Is interest inelastic. Now comes in the third and the last one, which is speculative interest rate, right? Speculative motive has a slightly different shape of the graph, and I'm about to show you that, right? So speculative motive, as I explained, is when either you hold your money in the form of cash because banks are not offering you high interest rates, or if bank is offering you high interest rates, right? So if bank is offering high interest rates, you definitely want to put your money in a bank account. But if not, then you want to hold your money in the form of cash in case you come across some better opportunity, like to invest in stock exchange or to invest in real estate or blah, 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 gold, and so on and so forth, right? Now, you have interest rates on the y-axis, you have quantity of money on x-axis. And the way you'll make this graph will be a downward sloping curve. Simple. Why? Let's have a look at this. So if banks are offering higher interest rates, which means that you are operating somewhere on point A, and then you are, then there's this point B, and then there is this point C, right? So on point A, your interest rates offered by the banks are highest, right? Yes or no? So you would not want to hold cash, and instead, right? And instead you would want to deposit your money in the bank. Yes or no? So you are holding only 200 perhaps in cash. Students, are you following me? Now, this is the trick part, so I want you to understand. If banks are offering high interest rates, you don't want to hold your extra income, your savings, basically. This is what we're talking about. Speculative motive is about savings, right? So if banks are offering higher interest rates, you want to deposit your savings where? You want to deposit your savings in bank account. Am I making sense? Right? Because that's providing you a better return, right? But if you move from point A to point B, now interest rates are dropping, you can see for yourself, right? So interest rates are dropping. Therefore, you would want to hold cash and not put money in the bank, because this cash would be then available to invest in other instruments, right? Like gold, stock exchange, and all those that I mentioned, right? Are you getting me? Right? And if it falls even further, so this is what it is. Therefore, you would say that speculative motive is inversely related to interest rate, right? So higher the interest rate, lower the speculative motive, and vice versa. Speculative motive is inversely related to interest rate. Any confusion so far? Students, is everyone clear? Related to interest rates. Okay, now if this is good, then move forward. Are all of you following me? Right? If there are any questions, feel free to drop in the chat or unmute yourself and ask me, right? Clear. Okay, very nice. Excellent, right? So we are going fast because obviously there's a lot of pressure to do more in less time. Okay, now when you combine transactionary motive, precautionary motive, and speculative motive. So when you combine these three motives, then becomes that gives you the demand for money. Yes or no? So demand for money, as I told you, is made of these three motives. So now I'm kind of combining the graphs of transactionary, precautionary, and speculative motive. So when I do that, the overall demand curve, now listen to me carefully. When I combine the transactionary, precautionary, and speculative motive, the overall demand for money graph would also be a downward sloping line. Are you following me? So when I combine, right? So there's a question, right? Right? So quantity of money graph overall would also be downward sloping, and that is achieved by adding up the transactionary, precautionary, and speculative motive. Easy? Am I good on this? Okay. Now, the idea is fairly simple. And why is this downward sloping? Demand for money. So demand for money curve is downward sloping because of primarily speculative motive. You know this, right? So demand for money is downward sloping because we know that is because of speculative motive, which is inversely related to interest rates, right? Okay. Now, what it shows you, it simply shows you what speculative motive was showing you, that higher the interest rates, lower the demand for money, lower the interest rates, lower the interest rates, higher the demand for money. High interest rates, lower demand for money, lower interest rates, higher demand for money, right? Easy. We good on this. Any confusion? This is M1, this is M2. Okay, are we good? Okay, let's move on. So that was about the demand for money, right? Now, liquidity preference theory says that interest rates are based where demand and supply of money are same. So we have talked in detail what demand for money is, what its graphs look like. Now it's time to talk about who supplies money in an economy, right? So who supplies money, right? And we will then see that how interest rates are being determined, right? Yes, Amna, you have a question? State Bank, correct. Yeah.
So when we draw the graph of all the three together, isn't it two horizontal and one curve like you've drawn before? Wouldn't that also have two horizontal lines considering
No, we have merged it. When we merge it, Amna, right? So I mean, it would take some mathematical explanation to explain how that would be, but overall the curve of the line, as I would say, or the shape of the curve becomes a curve overall, right? So because are you getting me? So it will not, you can't make three graphs. So when you merge these three, right, so it will overall become a curve. And the shape of demand for money curve is basically downward sloping because of speculative motive. So this is the correct way to explain that the shape of demand for money curve is downward sloping or inversely related to interest rate because of primarily of speculative motive. That's how you need to think about it, right? Okay. Now, if this is clear, students, think about this. Who supplies money? According to liquidity preference theory, right? according to liquidity preference theory, it's the central bank, because they are thinking about what? Currency notes, central bank, right? So central bank is the one, right, that prints currency notes in any country, right? So its supply is determined by the central bank. So supply of money in an economy is determined by the central bank. Okay. Now, again, according to liquidity preference theory, supply of money at any point in time will be fixed. According to liquidity preference theory, the supply of money at any point in time would be fixed, which means it will be a straight vertical line. Students, are you following me? According to liquidity preference theory, the supply of money would be fixed at any point in time. Therefore, it will be a straight upward sloping line like this. It will be a straight upward sloping line like this, right? So this straight vertical line is money supply. This downward sloping line is demand. So where the demand and supply of money intersect, that is your equilibrium interest rate according to liquidity preference theory. Right, sure, right? So think about this. Let me give you a very quick recap of everything, right? So liquidity preference theory says, unlike loanable fund theory. Now, loanable fund theory was saying that it's the demand and supply of loans. Now, be careful about the wording we're using here. So loanable fund theory said that it's the demand supply of loans that determine interest rates. The downward sloping was the demand for loans, which is made by borrowers. Upward sloping was the supply of loans, which is determined by banks. With demand supply equals, that's your equilibrium interest rate. Any confusion so far? We good? Okay. Liquidity preference theory has a different take. It says that it's not the demand and supply of loans. Instead, it's the demand and supply of currency. It's the demand supply of money or currency that determines interest rate. Liquidity preference theory says this, right? Now, on the demand side, we discussed in detail that what comprises of demand for money, what comprises of demand for money. And we came up with three reasons, right? Transactionary, precautionary, and speculative motive. We discussed those in detail. We looked at their graphs, and then we looked at the overall demand for money graph, which is downward sloping. Easy? Everyone clear on this? So overall demand for money is a downward sloping curve. Then, according to liquidity preference theory, who supplies money or who prints currency notes in a country? We know this, right? So it is the central bank that does that. Easy, right? It's the central bank, right, that does that. Okay, now this being said, the central bank will print, now this is a very important point for you to understand. The central bank will only print as much currency as much is needed in the economy, right? Are you getting me? Now, what is the need of the economy? I'll tell you in a bit, but for now, just focus on the words I'm using. As much currency, as much is needed, as much is needed for the economy, right? So that means that during a certain time period, it will be fixed, right? It's not that since Pakistan, Pakistan was established or, created, right? Whatever, right? There hasn't been increase in our money supply. There has been increase in our money supply, right? But, at a certain point in time, the money supply is fixed because that's only according to the need for the economy, right? Exactly. So money supply, very simply speaking, so you just produce as much additional money, as much, right? So the change in currency notes, right, is equivalent to the change in GDP. So when your GDP grows, right, that's correct, right? So change in money supply, right, or currency notes to be more precise, right, is according to the rise or the increase in your GDP is equals to change in money, sorry, what I'm writing, change in GDP, growth in GDP, you can say, right? So that's how much is the need of currency in an economy, right? Okay, now if we keep moving, right? So let's keep moving, right? Is everyone clear on this? Okay. Now, at a certain point in time, the money supply is fixed by the central bank. And as I said, that is based on the demand, how much, sorry, that's based on the need for the economy. So depending upon how much is the need for currency notes in an economy, that is how much, the central bank will print. So where the supply for money is equal to demand for money, that is where the equilibrium interest rate is. That's where the equilibrium interest rate is, right? So that is what liquidity preference theory says. Any confusion so far? Anything that's not clear? Okay, now the next thing, students, that we're about to do, yeah, quickly. Does anyone has a question?
Oh, no, sir.
Okay, the broad and narrow money are linked to this. Yes, yes. So let me answer that for you. Yes, Mubin. So the idea is, okay, nowadays, now after you have understood, now listen to me very carefully, because the next things that we're about to do can be a little complicated, right? So you have to understand this very carefully, right? Now, Mubin and everyone else, the idea is that back in the day, these theories are quite old, by the way. These theories, loanable fund theory and liquidity preference theory, are quite old, right? I mean, old, I mean, they were established back some time ago. After that, modern economies have progressed a lot. Or to be more precise, the banking system has progressed a lot. And nowadays, you know that there's so many different ways of, making transactions, right? So you don't necessarily need currency notes. You can make a payment through debit card. You can make online transfers. You can pay people, through mobile wallets. I mean, there's all sorts of things going on, right? Now, within that, therefore, since there are so many ways to make payments, right? Now, nowadays we define money in two ways, right? So money supply is defined in two two categories, right? So one we call narrow measure of money, and the other we call as broad measure of money, right? Narrow measure and broad measure. Now, what's the difference between the two, and why do we distinguish between these two? I'll tell you in a bit, right? So narrow measure, and this is very much linked to what's coming up next after this, right? So narrow measure is only the currency notes, right? The deposits, bank deposits plus the currency that people hold in their wallets, right? So have a look at this. Deposits in a bank, cash deposits, I mean, you understand what deposit is, like in the form of cash. So if my some cash is lying in my bank account, deposits in bank plus currency notes in circulation, right? So it does not include the bank loans, currency notes in circulation. Whereas the broad measure, as we will see, also includes what does broad measure include? So broad measure includes narrow measure plus what? Plus bank loans, right? Because why so? Let me give you a quick explanation around that. So demand deposits are also, demand deposits are also kind of cash that are lying in your banks, right? Are you getting me? So is this making sense, Mubi? Right? So students, think about this. So narrow measure is about basically the currency that's being in circulation. Now you have to listen to this very carefully. Currency, you would have absolutely no problem understanding that currency is money, right? Because we go to a shop, and that is what we have seen growing up and everything. We go to a shop and we pay cash and we get whatever we have to buy, right? If we are paying the exact amount that's if we are paying the price that's it's set for. But is it the only way to buy something? That's my question. So is paying cash the only way to buy a product? And the answer to that is no, right? I can go to a bank and I can present my debit card, credit card, right? Similarly, if there is a bigger payment, I can pay someone through a check, or I can make an online transfer, or I can pay through my mobile wallet, or so on and so forth, right? Now, if you think of loans, right? So loans are allowing people to, right? Loans allow people to buy, right? So let's say with my current income, I cannot buy a car. But when I go to bank and borrow money, take a loan, car leasing, car financing, right? Then with that money being available, I will be able to buy a car. So do you think that bank loans can be money? Because they're at the end of the day serving the same purpose. They're allowing people to exchange goods to buy goods. Are you following me what I'm trying to say, right? So since nowadays loans are, and the next thing that we're about to discuss will tell you exactly that how banks create loans. How banks create loans, that's the next thing that we're about to discuss, and that's known as credit creation, right? So again, quick recap. Money supply in modern economy is divided in two categories, narrow and broad. Why? Because back in the day it was only the cash that we had to have to buy a good and service. Nowadays bank loans can also allow you to buy things, right? It increases your purchasing power. As I just gave you the example for, I can't afford a car on my own because I don't have enough cash or money in my bank or at my home, but by taking a loan from a bank I can buy that car, and so on, right? So in the narrow measure, it's only the deposit or the cash in banks, the cash lying in banks, or the currency notes in circulation. Circulation meaning how much cash is in your pocket, how much cash is in my pocket. You add all that cash up, that will give you the narrow measure of money, right? For the broad measure of money, it includes the narrow measure plus bank loans, right? Right, it has number associated with them, absolutely. So that is going into more detail, yes. Then there, to be more specific, right? And to exactly know what we are calculating. So it goes like whether it's M0, M1, M2, and so on. Money supply one, and yes, that's correct, Mubin. Absolutely, right? So that would be going in more detail, right? But that's what you need to know as far your syllabus is concerned, right? Okay, now students, moving forward, now it will be a very interesting topic thing that we're about to discuss, and that's known as credit creation. Now, credit creation is the process how banks create loans, and in turn, and in turn, they increase money supply of an economy. Let me write this down. Right. So, credit creation is the process. How process of how banks issue loans, and through that they create or increase money supply, and through loans they create, they increase would be a better word, they increase an economy's money supply, right? Okay, now credit creation, credit is basically, if this is a little difficult for you to remember, right, economy is money supply. So credit is when you borrow something, if you think about it, right? So what is credit? So if I say that we need credit, mega lecture needs credit to execute this plan, what we are saying in simple words is that we need some funding, we need some money, we need to borrow from somewhere to be able to execute this, because we ourselves do not have enough funds. That's what we mean credit, right? Lending, yes, exactly, right? Right. So obviously, whenever there would be lending, so it refers to more on the borrower side, Mubin, but there has to be a lender to be a borrower, right? So the transaction will never complete unless you have both sides of the transactions. You need to have lenders and borrowers. So when I say I'm taking credit, so who will be providing me credit? The bank. So bank is the lender, right? And who's the borrower? Mega lecture or me or someone else, and so on, right? Okay, now students, credit creation is the process of how banks issue loans, right? So that's what we are about to learn here, and how through loans they increase an economy's money supply, because we just discussed that loans, bank loans, are part of broad measure of money supply, right? Is everyone following me? Any confusion so far, students? Anything that any one of you did not get here, right? Okay, now this could be a little tricky, but I'm sure you will understand it. Okay, now have a look at this. So that's the first thing that we discussed, right? So there's a bank, and the purpose of a bank is to connect depositors or savers who save their money in a bank, right? and bank channelizes their savings to borrowers. Bank doesn't has its own funds. Primarily, the funds are coming from the depositors, right? So if you have some saving lying in your bank account, what do you think? That when you take cash, now listen to me very carefully, when you take cash and deposit in a bank, so do you think that those actual cash notes that you deposited, right, in a bank, that would be lying in your bank account in some locker, in some drawer, in some, whatever you want to call it, right? And the answer to that is no. Bank is always circulating the money, right? So whatever money is coming to the bank from depositors, bank give it to the borrowers, and then borrowers return the money to the bank, and then bank pays back it to the depositors. But now things will start becoming more interesting. This is obvious, right? Depositors deposit in the bank, bank use this money to lend it to borrowers, then borrowers pay back the money to the bank, and then pay backs the money to depositors. But this is about to get more interesting, right? Okay, now have a look at this. The idea is, let's say there is one bank, right? So you can take example of any commercial. We are talking about commercial banks, by the way, right? So commercial banks lend money or lend or give loans to whom? Public, general public, right? So commercial, do you know what commercial banks are? Commercial banks are these profit-making entities. Most popular banks that you see here and there, right? So what are these? These are commercial banks, right? Like for instance, in Pakistan, I don't know if all of you are from Pakistan, right? Standard Chartered, you must have heard about, right? Bank Al Falah, Allied Bank, Habib Metro, blah, 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 right? And even in your own countries, the most popular names that you come across are commercial banks, because commercial banks lend money to general public, right? Central bank doesn't lend money. So you can't have your bank account in the central bank, right? So central bank has accounts of commercial banks. Central bank is at the highest level, right? Institution which people save and obtain loans. Exactly, simple, right? So central bank is providing you, central bank provides banking services to commercial banks, right? And then commercial banks are providing these banking services, right, to general public. General public means all the businesses in that country, and all the people and individuals like you and me, right? So you have commercial banks, and commercial banks are providing these services to customers. General public is a better word, right? General public. Okay, now students, here's the thing. So the class link is about to expire. Let me quickly send you the new link. So I'm ending this class, rejoin with the same link. It is. Did you just check? Okay, but I mean, it was a brief one. I'll check again. Initially it was, but I mean, if you have checked and you know for sure that it's not, then it's fine. But this credit creation is, right? So this link is about to expire. Students, can you quickly rejoin? I'm ending the class, rejoin with the same link, right? So we can continue for 5-10 minutes more and then we'll stop. Rejoin.